Time to run through an introduction here for any transactions between an entity and an owner with their corporation. We're dealing with formation, subsequent transfers of stock. Let's get a nice introduction here. For formation, during the formation of a corporation, when shareholders contribute property in exchange for stock, gains and losses are generally not recognized by the shareholders or the corporation. This is pretty much the case for most types of entities. We'll see partnerships as well. This, however, is going to have an extra rule. This non-recognition of gains or losses is applicable when the contributing shareholders, as a group, have at least 80% control of the corporation immediately after the transfer of property. This is a rule, and I would know it. It's not like they harp on it. It's not like there's tricks that they try to really throw at you with it. And just keep in mind, this is when it is formed, not when it IPOs or goes public. Also, this applies to corporations that are not large companies as well. This rule allows corporations to be formed without triggering immediate tax consequences for the shareholders or the corporation. Subsequent transfers of stock. In contrast to the initial formation of a corporation, any subsequent contributions of property to the corporation in exchange for stock may not result in the 80% control requirement being met. This can happen when, let's say, only one member of the original contributing control group transfers assets for stock, or when a new shareholder is admitted to the corporation. So you only get this benefit at formation when you start up. After that, sorry, you're SOL. When the 80% control test is not met, the contribution is treated as a sale to the corporation at fair market value, which results in the recognition of gain or loss by the contributing shareholder. Think of it like you are now. If every single shareholder contributed at the same time, that would be different. But if you don't control 80%, when you're doing this, then you will trigger a possible taxable event. In this scenario, the contributing shareholder will recognize a gain if the fair market value of the stock received is higher than the adjusted basis of the property contributed, which makes sense there. Conversely, if the fair market value of the stock is lower than the adjusted basis of the property, the shareholder will recognize a loss. The recognition of gains or losses in such cases can have tax implications for the contributing shareholder, as they may need to report and pay taxes on the recognized gains or claim deductions for the recognized losses. All right, pretty meaty for an introduction. We're getting right into it. Hey there, are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.